Good morning and welcome to the webinar this morning. We welcome you to a beautiful day in Anchorage, Alaska. Hope that you have a chance sometime to come up and visit the wonderful state and come and visit us. We're glad to have you participating with us for this webinar this morning. We will have an opportunity to hear from several CPAs out of California, and I will introduce them in just a moment. But before we get started, I wanted to just give a quick introduction to Alaska as a trust jurisdiction. As one of the preeminent trust jurisdictions in the United States, Alaska is recognized as having the best decanting statute, as well as being the first to adopt trust laws for self-settled trusts and domestic asset protection trusts. In recent conferences that I've been to, it was recognized as having the best asset protection in the United States for domestic trusts. And as the slide says, it's the only state that has a private ruling letter from the IRS to that effect. In the bullet points, it says here, the quiet state. Why do we refer to ourselves as the quiet state? Many of the states that are strong trust states are very active in announcing themselves as the new tax jurisdiction or the best place to go for privacy or things like that. And we've seen a lot of headlines. We prefer ourselves to go about doing our good work here in Alaska that Kodiak Trust Company and the other trust companies in Alaska do, in a way that's professional and yet private and quiet. Kodiak Trust Company was formed in 2017. It's a fully licensed trust company here with the state of Alaska. We have professionals on staff that have been in the industry for many years. Myself, I started in investment advisory, but working quite a bit with clients, doing their structures and working on what they needed to provide estate planning for their families. And that kind of progressed me on to where I am now running Kodiak Trust Company. Our area of focus is generally worldwide, but specifically we have quite a bit of knowledge in Latin America, particularly in Mexico, where we have a large number of our trusts, and have in recent years developed out our domestic U.S. trust business, as well as working with several other places in Western Europe, as well as the rest of Latin America. We have Spanish-speaking staff, which makes it very easy for many people in Latin America to work with Kodiak Trust Company. Being independent is a very nice feature for us. We're not connected to an investment advisor. We're not connected to a bank. Therefore, we have the flexibility of being able to work with multiple brokers or multiple investment advisors or attorneys. We're not beholden to any one group, which makes it very nice for the client to have a very secure feeling that they're getting advice or having eyes on things that are happening perhaps in a brokerage house or just another set of independent eyes, which I think is key role for any trustee. In today's webinar, we're going to hear from several CPAs and Anthony, who's an attorney, principally on tax issues related to trusts and tax issues related to California. And Jack has been with his firm of Chu and Waters for over 40 years, and is a CPA, graduated from Berkeley and got his master's in taxation through Golden Gate University. He's very involved in the San Francisco Bay Area in multiple profit and nonprofit organizations, and acts as an excellent friend to our firm, and has been known by many of the principals in the firm for quite a while. Anthony and Thomas Vo who are also participating on this call are also with Chu and Waters. Anthony's an attorney, and Thomas Vo is a CPA. So I hope you enjoy this this webinar. We're looking forward to hearing from Jack, and I'll go ahead and turn the time over to him.
All right. Sorry for that slight delay. Had a little problem with the technology, got frozen out a little bit. So want to thank Jeff for the kind introduction, as well as being able to participate in this webinar put on by Kodiak Trust and Company. I think what we should do is just, give you a brief background on the Biden tax proposal. As we all know, during the campaign for the presidential election, he put out, certain hints what he planned to do and increase rates, et cetera, et cetera. But the problem was that he never put together a white paper that normally presidential candidate usually puts out into a campaign in terms of the tax plan, the tax reform. So, so what we have put together basically is information that we gather from different sources and everything else. Just recently, just today, as a matter of fact, we went in and looked into the tax foundation, and they just recently came out with their the fiscal fact number 751, which is February of 21, which is really current, that lists out in detail what they gather in their discussion with Biden's representative about the various tax proposals. So again, it's really it's a little bit here, it's a little bit there. There hasn't been any formalized white paper, but I think the one that is put out today by the Tax Foundation, number 751, it's a good one to take a look at. So just want to throw it out there. So before we start the presentation, what I want to do basically is also talk about what are the chances of of any of this changes get passed by Congress. As we all know, basically, right now Congress is at dead tie at 50-50. So in order for him to pass it, he needs roughly 10 Republicans to come over, so he could basically have a 60 votes situation. But more than likely that won't happen. More than likely what he's going to try to do, what more than likely the Biden administration will try to do, is push through the bill through the reconciliation process, which means all he needs is 51 votes. But getting that 51 vote would be difficult as well, because there's quite a few blue dog Democrats that is in the Senate, which I think one just recently spoke out against one of Biden's cabinet nominee, McCheney, from senator from West Virginia, as well as the senator basically from Arizona. She basically spoke out against the filibuster as well too, that wanted to retain the filibuster. Same with Manchin as well. And John Tesler is also a Democrat from the state of Montana, basically, that's pretty much voted quite a bit for ex-President Trump. So trying to get 51%, try to get 50 votes and have Harris break the tie, it's doable, but but there's going to be a lot of changes. So I just wanted to throw that out to you, that basically that they could pass this bill, probably not right if they do get the 51 vote. But the problem that we have, basically, there's a budgetary process that's needed to pass the stimulus bill that's currently right now being talked about, and the federal budget basically ends on September 30th. So conceivably, starting October 1st, you could rush into Congress and try to push through the bill before the end of 2021. But the chance of that, basically, I think it probably will be very difficult. So so give me this background. So I'm going to start going through some of the changes, and then afterwards, then we could talk a little bit more about it or answer some questions that you may have. So the first slide is what the effect on the individual tax rate. As we all know, basically, pretty much that there's discussion about increasing the top rate back up to 39.6%. and also short-term capital gains back to 39.6%, and also raised income taxes on income over 400,000 without any, supplying, specific. And again, these are all, there hasn't been a concrete proposal, but I think that, as I mentioned to you, the best thing to do is look at the fiscal fact put on by the Tax Foundation. It has a little bit more detail on it. So this thing is a very evolving situation. So I think the most important thing, basically, again, is to keep in mind that rates will go back up to 39.6 again, and then also capital gains rate may also go back up again. So, but this is the first slide. So the second one, basically, we talked about, higher individual maximum rate on long-term capital gains. Right now, long-term capital gains is 23.8%. So his Biden's proposal is that if you have income over $1 million, the capital gains will be taxed at 39.6 again. So there's quite a bit. So if you add on the 3.8%, the net investment income tax rate, you could have a situation of 43.4% as your rate. So it's pretty extensive. So the planning strategy would be, if you're going to basically, if you have, long-term capital gains, best thing to do is try to realize that now, or basically, if you think that future appreciation will not happen. So again, it's one of those really, judgment call that, that needs to be made, and trying to forecast whether or not this law will ever pass or make it through the day of light. So it's one of those situations that needs to be considered carefully, but should be in the back corners of everybody's mind. Anthony, do you have any comments on this?
No, I mean, ultimately is my mic on?
Yes.
Ultimately, the concern is whatever does pass, it could possibly be passed retroactively as well. So it's rare, but it has happened before. The Tax Reform Act of 1993 was signed in August and made retroactive to the beginning of the year. So everything that we're talking about, it's all hypothetical. And as you discussed, there's quite a lot of pushback from kind of moderate Democrats. So we might not get everything that Biden has claimed that he wants. And that Democrat pushback could also push back against getting it retroactively passed. But it is possible that everything that you just talked about could be effective January 1 of this year.
Yeah, it could be, but I think the odds were is less.
Yeah.
So I won't plan in anticipation of the passing of the bills, or really make some. You really need to sit down and really think through this whole process, because you really sort of like executing transaction without just educated guess when that's going to pass or not. So let's go on to the next slide. And then one of the another Biden proposal would be increase the Social Security tax as well. So it's pretty straightforward, and there's really one of the benefits, one of the planning mechanism is to avoid that, especially if you have a business owner and the business owner operates in a S corporation format. So there's some planning strategy there, basically, in terms of taking a reasonable salary out, and then any excess earnings could come out basically untaxed as dividend distribution. So that's a kind of another planning vehicle right there for to minimize some of the increases in the Social Security tax. Let's go to the next one. Okay. And then another Biden proposal is talking about eliminating the $25,000 exemption for passive loss rule, and B is a really a very harsh one, is eliminating 1031 exchange. So that's I think that's going to get a lot of pushback from the real estate industry lobbyists. So it's really difficult. That one, it's really difficult to plan for, given all the uncertainties and everything else. Like, if you do have a piece of property, and then the problem is you make this bill retroactively, you do a 1031 exchange now, you buy another piece of property, it's retroactive, then you just stuck with, without the cash flow to pay the taxes, because you use the cash flow to buy another piece of property. So in a way, that 1031 exchange, I think that's going to get a strong pushback, especially from the real estate lobbyists. But on the other hand, if you look at the 1986 Tax Reform Act, which basically, completely started the passive and the active loss route, completely, destroyed the real estate syndication business, the tax shelter business there. But the good news there is that the rate came down to 25% before it ratcheted back up to 39% over the years. So another one, basically, the bonus depreciation gets, will eliminate that rule for certain real property improvements. So if you are going to plan to do something, I think what you may want to do is consider, especially with equipment, like, for example, the bonus depreciation. If you're in a business, if your company needs capital improvements, if you need that equipment anyway, strongly suggest we do it now and basically be able to capture that bonus depreciation right off. Yes, he may make it retroactive, but on the other hand, he may not. So I think the best thing to do, if you need to do it, capture it now rather than wait until the end of the year. And then the next one is basically eliminating that 20% qualified business income deduction from real estate. That's a very strong incentive, for real estate holdings. So when you eliminate that, that pretty much put everybody back on the same level of tax. Then also phase out the QBI for business with your income over 400,000. So again, these are pretty draconian type of proposal that could really increase your tax rate pretty drastically if you're in that particular category. So, but on the other hand, it's really difficult again to plan for it because of the fact that the uncertainty that's out there. So let's go over to the next one. The next one basically is itemized deduction. He's going to basically propose a maximum limit of 28% for upper income individuals. But the good news is basically they will talk about basically allowing state tax deduction, especially for blue state, so which is really great. But on the other hand, you also cap by the 28% as well too. Anthony, you any comments here?
No. I mean, the increase in rates are actually, if anything, is going to be retroactive. It's going to be the increase in rates because that's exactly what happened in 1993. It's less likely to happen to something that'll be a gotcha or a switch and bait or bait and switch, if you will, where you did something that you thought was going to be tax-free and all of a sudden it's taxable. That's going to be far more likely to challenge than just a retroactive rate increase, which has been continually approved by the courts in the past. So whatever happens, there could be multiple effective dates in Biden's legislation, and so once again, this particular provisions, the increases in rates are most likely, including the increase of rates for capital gains ordinary, that could very well go back to January 1st effective dates. So we're working under a veil of uncertainty right now, considering what Biden has said he wants to do. But we don't know what he's going to effectively get out of Congress. So.
Thank you, Anthony. Let's go to the next one. It's basically, do credit for home buyers and renters. So that one's pretty straightforward. So that's something that is great for the economy, great for the first-time home buyers, and so let's move on to the next one. And then basically, he wants to, part of his climate change proposal is to, again, basically the green energy tax changes. So, and if you have clients that are in the oil and gas business, we got a problem there. Basically, propose to eliminate the depletion allowance right there too as well. So So something to keep back in mind, for tax credit as you continue to improve your residential and commercial building. So you could have credits for certain electrical vehicles and product produced at safe energy. So that's another tax incentive, to move a policy of administration in terms of the climate change. Let's go to the next one. Okay, I think this is the one that basically is having some problems with everybody that our clients that we talk to. It really is a sense of uncertainty here. Basically, is that again, there's no specific detail, but there's discussion about basically the exemption rate coming down from 11,500 to 5,500. If the proposal is passed, but on the other hand, by the year 2025, it will become law anyway. So something to plan for right now, and we working with quite a few clients in terms of planning to basically make gifts or basically sale to a effective trust to maximize the exemption and continue to make gifts. There's also some strategy that Anthony could touch on later on, is about setting up spousal trusts right now, making gifts to transferring property to a spouse where basically the beneficiary will be your children, but the spouse is able to use the property. So let me pass on that to Anthony, and he could expand on this area, dealing with the spousal trust, as well as some of the changes in terms of elimination of step-up basis and that situation. Anthony, you want to take it here?
Sure. So first, is just to correct what Jack was saying, it was like 11.5 million to 5.5 million. So the doubling up of the lifetime exemption is going to automatically go away in 2025. We don't know what Biden's going to do. It could eliminate it lower sooner. It probably won't go below the 5.5 million, because that's actually what was said under the Obama administration. So if that's probably the baseline, they could just maybe let it die naturally, get to that point come in 2025, or the next tax bill could actually drop it down immediately. There's been a lot of conjecture on what Biden actually meant by the elimination of the basis step up. He called it a loophole. So it's not clear whether or not he's talking just about, or he was talking just about the fact that people that didn't have taxable estates were going to get their basis step up eliminated. So currently, if you pass away and you don't pay estate taxes because your estate is under 11.5 million, all of your assets would get an income tax basis step up, even though you didn't pay estate tax. If he's talking about eliminating the income tax basis step up for people that also have to pay estate tax, we're talking about possibly somewhere around 80% taxation on an asset that has, that's 100% gain that someone has to pay estate tax for, and then the heirs have to sell that asset to pay the estate tax, and they're going to have to recognize potentially ordinary income rates on that sale at another 40%, and that doesn't seem right. There's been some conjecture that he's talking about perhaps outside of the estate taxed assets. That really what it is that we're going to follow the Canadian system, where everybody is deemed to sell all of their assets on death and have capital gains on all of their assets, kind of on a final income tax return. So blanket elimination for everybody, it just doesn't make sense. And because he's been so vague in talking about it, and the fact that he's referenced it as a loophole makes us think that this is going to be a more limited basis step-up elimination than just blanket basis step-up elimination. So there's that. So back to what Jack was talking about. So I forget exactly what year it was. I think it's like 2012 when everybody thought the exemption was going to decrease down from like 3.5 million to 1 million. It was all the rage for people to go doing spousal lifetime access trusts to be able to use up their higher exemptions before the exemptions decreased back down to the pre-2001 Tax Act levels of $1 million each. So here we are again. We're faced with another decrease impending decrease in the estate tax exemption amount, possibly a sizable one. So we're back up to the spousal life. People are talking about spousal lifetime access trusts again. So what it boils down to is you and your spouse make gifts to each other that use up your personal lifetime exemption, with those trusts having potential beneficiaries being your kids or whoever it is that you want to benefit from. The pitfall for spousal lifetime access trust is twofold. I mean, what if you divorce? I suppose your benefits are relying on kind of the continuing to benefit from access to the gifts that you made to your spouse, and vice versa. Another is anything that you actually draw out of the trust and consume in life, you're actually wasting your exemption on. So to the extent that you could have made a direct gift to your kids, so if your estate is worth well more than $11 million, you probably would just make direct gifts to your heirs instead of doing it through the spousal lifetime access trust. That trust is primarily for people that still need their wealth, still need their assets, but want to take advantage of the higher exemption amounts. So we're hearing a lot of talk about that to the extent that these exemptions are made, or rather the reduction of the exemptions are made retroactive. It could be too late to do that. And we've been hearing talk about doing kind of contingent gifts, such that it's written into the transfer, such that if the exemptions are reduced, that the gift doesn't happen and it gets eliminated. There's some case law that's allowable where when the excess goes to charity. I'm not so sure that these contingent gifts would be sustained if they do retroactively change the law, but to lower the amount of the gift, that is. But all the same, I mean, we just could be paranoid that doing these things could just be paranoia that the law will be retroactive when it very well might not be. So that's effectively what we're back to where we were in 2012. People are rushing to use their lifetime estate and gift tax exemptions. One of the things I'm not seeing that talked about that I personally am a little concerned about is so if you recall, just before Trump was elected, IRS issued these 2704 regulations that were potentially going to strip the ability to make discounted gifts to interfamily discounted gifts, or severely hamper them anyway. Trump comes into office. He gives an immediate executive order that all regulations should be reviewed and withdrawn if within a certain amount of time if they couldn't be finalized. Those regulations, the 2704 regulations, were withdrawn. They could come back. They could come back before any tax law change happens. If they come back, we could have a very short-term window before we lose the ability to make discounted gifts to interfamily transfers. So one of the primary things our clients have been doing, and including last year, a lot of this was happening last year, right after the election, is to make discounted sales to their intentionally defective grantor trust for the benefit of the heirs, to be able to take advantage of their exemption, because they would make cash gifts to the idiots to make the purchase, take advantage of their remaining exemption, and two, take advantage of the ability to discount transfers. I mean, we could be losing that as well. That was proposed under the Obama administration, and Biden could very well bring it back. But it's a regulatory process, so that does take time, but proposed regs were already issued. So a new form of those regs could be issued again. Excuse me. So that's all I got on that.
Great. Thanks for that presentation, Anthony. There's also one thing, in getting back to the estate planning area, what we're doing for our clients right now is focusing on this year, 2021, in terms of, the effective transfer of property through, the sale to the defective trust. So we're focusing quite a bit on that, and focusing quite a bit also on, qualified residency trusts as well, to take advantage of that situation. Recently in California, as we all know, basically Prop 19 passed, and prior to February 15 deadline, we were quite busy with our client in terms of making certain transfer to trusts to take advantage of the Prop 19 before Prop 19 were to take into effect. But I think from our standpoint, I think for the estate planning, we're planning on a basis that the law will change in 2022. So we're trying to do everything we can this year to, especially in maybe perhaps the first part of the year, is to go through, all the, the sale to a defective trust, certain residency, qualified residency transfer that we do with clients' vacation home as well. So that's not in California. So we're implementing quite a few of those planning situations. So let's move on to the Biden's proposal to corporations. Okay. So want to increase the rate from 21% to 28%. Still relatively a good rate at 28%, and then propose a new 15% minimum tax on corporation with at least $100 million in annual net income, and also raise the Gilead tax to 21% from the 10.5, and impose that on a country by country basis. So in essence, with the Gilead tax, is pretty much tax you on your foreign control companies with net income after a certain return on the assets of the company, and that tax will be pulled into your individual return. Normally it's at 10.5%. Now it's at 21%. So additional revenue raising situation. Still, the corporate rate at 28%, still relatively inexpensive to the 39.6 that he planned to propose. So operating in a C corporation format, especially when a company needs working capital, that would be the ideal way to go. However, keeping in the back corner of your mind that eventually that you plan to sell the company, operate in a C corp format, you must sell stock rather than asset. Otherwise, then it'd be a double tax situation. We're going to move to the next one. This is our last slide. I think I spoke about that at the beginning, rather than right now. Is that we talked about, what are the chances of passing, and we talked about compromise with Republicans, but more than likely that probably will not take place, or if it does take place, the bill will be so watered down that that it won't, it'd probably be it'd probably be completely different than what these slides would show if there's a compromise with the Republican. Again, we talked about using the reconciliation process. So the budgetary process runs on a fiscal year ended 9/30 this year, 9/30/21. When more than likely the stimulus bill its passing will be using the reconciliation process. So conceivably, Biden could use that process for next year's budget as well, by passing it basically before the year end, but to take an effect of the following budgetary process, which begins on October 1st of 2021. So again, basically, which is, there's a lot of speculation here on, and also the various variables involved too. As I mentioned earlier, that we got some blue dog Democrats that may not even go along with, with his major proposal. So it's still up in the air. But I think from a planning standpoint, especially with the estate, I would plan right now, basically in anticipation of that of 2025. To be honest with you, you might as well do it now. Even if Biden's bill on the estate planning area does not pass, but I think we still should plan now because of 2025. So I think that's the best approach. So, uh, Anthony, any final comments?
No, I mean, we talked, the slide is talking about the use of the reconciliation and the fact that the reconciliation process has already been used for the stimulus act, the stimulus program that Biden is trying to push through. So they would be out of if this goes through and they continue, they actually pass it with reconciliation, they wouldn't have it available for the tax bill. But they get one per budget cycle, and so they could pass this later this year for next year's budget, this tax bill using the reconciliation process, and then make retroactive riders onto it. So, but we with the stimulus bill having chewed up the reconciliation, we do have some time. So,
all right. Thank you, Anthony. I think we're done. So.
Thank you, Jack, Anthony, and Thomas, for your wonderful presentation and being able to join with us today. We want to thank all that tuned in live and are watching the replay. We really appreciate your support here at Kodiak Trust Company. Quick reminder for those of you that don't know, we have another webinar coming up in March on the 17th, and that's going to be held at noon Pacific Standard Time. The presenter is going to be Rebecca Stewart, and her webinar is going to be on using other trust jurisdictions to benefit your client and enhance your practice. So we hope to see you there, and we hope that you have a wonderful day.